The double CCI trading strategy. The best scalping and swing trading strategy for beginners that no one ever told you. This video provides a clear, winning, step-by-step guide to how to successfully trade in the forex, stocks, commodities, or any financial markets and generate consistent profits. So, by the time you finish this video, you'll know exactly when to enter high probability trade using the Commodity Channel Index or CCI indicator. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. The double CCI is a trend-following trading system. Double CCI with 34 EMA is very good at catching the trends of the market very early, and it lets you ride the swing of the market until the end. Double CCI with 34 EMA can become a money-printing machine for you if you follow the rules of the system in a smart way. Double CCI with 34 EMA is a type of trading system which any trend-following traders would love to have. Its simplicity and its capability to create crystal-clear signals are some of the reasons why this trading system is so special. The double CCI system is one of the best zero-line cross strategies. The zero line is a trading strategy that uses the charting of the trading price of an asset to determine the entry point. So, in this strategy, traders use the CCI indicator to identify when bullish or bearish momentum is high to identify entry points for trades. The trade is based upon the CCI crossing over the zero line, while the price is on the correct side of the exponential moving average. The CCI displays the momentum of the price as a value either above or below zero. When the CCI is above the zero line, the price has upwards momentum, and when the CCI is below the zero line, the price has downwards momentum. When the CCI is crossing the zero line, the momentum is switching from one direction to the other. The zero-line cross-trading system uses this change of direction as its entry point and uses the price in relation to the moving average as a direction confirmation. The default rate uses a 15-minute bar chart or higher, a 50-bar CCI, a 25-bar CCI, and a 34-bar exponential moving average. The default rate uses a 15-minute or higher time frame chart, a 50-bar CCI, a 25-bar CCI, and a 34-bar exponential moving average. The default trading time is any time that the market is open and active. What is the Commodity Channel Index indicator or CCI indicator? The Commodity Channel Index or CCI is a momentum-based oscillator used to help determine when an investment vehicle is trending and reaching a condition of being overbought or oversold. The CCI indicator was created by Donald Lambert and was initially used to identify cycles in the commodity market. However, it tends to perform the same in the stock market or the forex currency market, and even the cryptocurrency market for that matter. As you may guess by now, the only indicator you need to spot new market cycles is the CCI indicator. So, what does the Commodity Channel Index tell you? The CCI indicator is primarily used for spotting new trends, watching for overbought and oversold levels, and spotting weakness in trends when the indicator diverges with price. When the CCI moves from negative or near zero territory to above 100, that may indicate the price is starting a new uptrend. Once this occurs, traders can watch for a pullback in price, followed by a rally in both price and the CCI to signal a buying opportunity. The same concept applies to an emerging downtrend. When the indicator goes from positive or near zero readings to below -100, then a downtrend may be starting. This is a signal to get out of longs or to start watching for shorting opportunities. Overbought or oversold levels are not fixed since the indicator is unbound. Therefore, traders look at past readings on the indicator to get a sense of where the price reversed. For one stock, it may tend to reverse near +200 and -150. Another commodity, meanwhile, may tend to reverse near +325 and -350. Zoom out on the chart to see lots of price reversal points and the CCI readings at those times. There are also divergences when the price is moving in the opposite direction of the indicator. If the price is rising and the CCI is falling, This can indicate a weakness in the trend. While divergence is a poor trade signal, since it can last a long time and doesn't always result in a price reversal, it can be good for at least warning the trader that there is the possibility of a reversal. This way, they can tighten stop-loss levels or hold off on taking new trades in the price trend direction. How the professional traders use the CCI indicator strategy. The zero line in the CCI indicator is the line in the sand between the bulls and the bears. This means that we can use the crossing of the zero line to gauge a shift in the market sentiment. So, here is how to trade using CCI indicator. When the CCI oscillator crosses from below the zero line, that's signaling a shift from bearish momentum to bullish momentum. In other words, the dominant market energy is to the upside. Conversely, when the CCI oscillator crosses from above the zero line, that's signaling a shift from bullish momentum to bearish momentum. In other words, the dominant market energy is to the downside. Now, we don't recommend completely relying on these signals alone. You need to use them in combination with your price action reading skills. Trading strategy. The following step-by-step tutorial of the zero-line cross-trade will use the British Pounds United States dollar forex market, but exactly the same steps should be used on stock trading, commodity, crypto, and whichever markets you are trading with this trade, because price action stays relatively consistent across different assets. Step number 1. Add the CCI and an exponential moving average. Add a 50-bar CCI, a 25-bar CCI, and a 34-bar exponential moving average. Step number 2. Watch the market. Watch the market and wait until the market is active and moving decisively. Wait until the 50-bar CCI crosses the zero line, while the 25-bar CCI is on the correct side of the zero line, and the price is on the correct side of the 34-period exponential moving average. This means that if the 50-bar CCI crosses above the zero line, the 25-bar CCI should also be above the zero line, and the price should close above the moving average, and vice versa if the 50-bar CCI crosses below the zero line. If either the 25-bar CCI is on the wrong side of the zero line, or the price is on the wrong side of the moving average, that is, CCI crosses above, while price closes below the moving average, the trade has not met its requirements and should not be entered. Step number 3. Enter your trade. Enter your trade when the high or low of the entry bar is broken by a subsequent bar. There is no default order type for the zero-line cross-trade entry, but for the recommendation is a limit order. As soon as your entry order has been filled, make sure that your trading software has placed your target and stop-loss orders, or place them manually if necessary. There is no default order type for either the target or stop-loss, but for the recommendation is a limit order for the target and a stop order for the stop-loss. Bullish trade scenario. When seeking to open buy positions, observe indicator readings as follows. First, the 50-bar CCI crosses above the zero line. Second, the 25-bar CCI should also be above the zero line. Third, the price should close above the 34-period exponential moving average. Entry. When these conditions match your target asset chart, it positively influences the asset price. So, open a buy position when the high of the entry bar is broken by a subsequent bar. Set an initial stop loss below the current swing low with a buffer of 5 or 10 pips. Bearish trade scenario. When seeking to open buy positions, observe indicator readings as follows. First, the 50-bar CCI crosses below the zero line. Second, the 25-bar CCI should also be below the zero line. Third, the price should close below the 34-period exponential moving average. Entry. When these conditions match your target asset chart, it negatively influences the asset price. So, open a sell position when the low of the entry bar is broken by a subsequent bar. Set an initial stop loss below the current swing high with a buffer of 5 or 10 pips. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Here are other examples of the double CCI trading, to fully understand this wonderful strategy, and to make the most out of it. double CCI system is one of the best zero-line cross strategies. It's easy to spot and trade, making it an effective strategy for beginners and professionals alike. However, no strategy gives a 100% profitability guarantee at all times. We suggest following money and trade management rules when trading with these strategies, besides practicing these at demo trading before applying them on actual trading. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell and leave us a like to show your support. See you next time.